Hey guys, Justin here from Simplified Investing. I wanted to put together a video into why specifically I think you guys should trade options and why I trade options. So this is something I get asked a lot. Why should I trade options versus any type of different type of trading, whether this be penny stocks, ETFs, or regular stock? So I will get right into it. Starting off, options trading gives you the most leverage that you can potentially have on the market. So what does that mean? That means you can trade potentially an Amazon call option for as little as $15 for say and see a large return rather than paying $2,042 a share. So you could have say a 2100 call option for $100 and see a 1,000 to 2,000% move potentially, while Amazon only moves 5 to 6% on the week. So giving you that leverage does increase your risk, but it does also increase your reward exponentially. And that is something that a lot of options traders like, and why I specifically recommend trading options over stock. You can see you get a minus 0.01% move here if you were to just trade stock, and there was options if you go in on the 5-day, 5-minute. This move right here on this double bottom that you could easily recognize on this 5-day, 5-minute, recognize this double bottom here. Not only is it a double bottom, you can see that first bottom, double bottom, triple bottom here into close. This move right here was over 50%. So you could either trade this stock and have to pay $2,042 for a negative 0.01% move, or you could have simply paid a option call here for over 50%. So that's the first reason why I do trade them, and I recommend you trading them. The second big key is that you have better returns. So there's three common types of trades or traders that people do or use. They can trade leveraged ETFs, they can trade penny stocks, and they can trade regular stocks, which I just went over. You don't see any return or any volatility with regular stocks. The people that are trading regular stocks are typically people that have $1 million accounts plus, so they can take advantage of these small moves with regular stocks. However, as most of you know, not many of you are going to have that large of an account, so options really provide you that leverage. So now you may ask, why are options better than leveraged ETFs? And I'll show you exactly right here. I'll do, say, DGAS, for example. I know that's one that some people trade. We can go on the 1-year, 1-day chart, and you can see that you get, or not 1 day, we'll do the 3-year week. You can see how drastically this price has changed, and you can even go to UGAS right here, where you see all of this. Look at how much you would have lost if you would have held UGAS long term. This is called beta decay on these leveraged ETFs. They slowly lose their value over time, which is another reason why they are a really tough hold. And especially recently, a lot of these moves that you've been seeing, you see that UGAS, it has moved 7% on the day. You can easily see that in an option price move within minutes. And also a lot of moves, especially with these ETFs lately, have been aftermarket hours. So this typically only moves 1 to 2% a day. And then if you're holding this long term, like we just mentioned, you can look at the 1-year, 1 day. Would you really want to invest in something that's $304 here and $19 here? That's a huge risk to take on. So if you don't have a play that goes your way, you also have time working against you. Now, do you have time working against you when you trade options? That's a definite yes. There is something that, or time that works against you with options, which is why if you are swing trading options, we always tell people to play at least a month out. And what that does is it gives you that time decay, which is also known as theta, to be less. It is the highest in the last 30 days, and it does provide more of a difficult chance to profit swing trading options that are within a month to expiration. So another thing that I get, well, aren't options hard to learn? They definitely are not hard to learn. They take time to get used to, as does trading any type of stock, but they definitely are not hard to learn. And I guess quickly to break it down, you have calls and puts. Calls, essentially, if you think that the stock will go up, and puts if you think the stock will go down. In simple terms, that's what it means. Strike price is when you or what price you think the stock will reach, and then you have expiration dates of when you think the stock will reach that price. In simple terms, that is what options trading is. We do go obviously a lot more in depth in our course to this, and it's a great asset or tool to find different strategies as well. And options can be risky, but they can also help you reduce risk. So there's several different strategies that you can use. You can use straddles, strangles, iron condors, and for example, you can play one of those strategies and set the price for, let's go to Disney for example. You can play an iron condor on this that say Disney will stay in between $92 and $115 and ultimately reduce your risk because you don't have to put in as much capital as you were buying stock here. And if it stays within that range, you still make money. So there's different strategies that you can learn besides trading naked calls and puts to really benefit or reduce your risk while also keeping that reward still in play. And they're easy to short. A lot of people ask, well, the market's down, how do I short and things like that. A lot of people don't know what shorting is. In essence, with options trading, that's simply just playing puts. So you don't have to do anything other than buy a put option for, say, Disney. Say you think Disney is going to go down, you can simply play a put option that will gain value as Disney increases it or decreases in price. So I wanted to give you guys this quick little breakdown or tutorial into options trading, why I personally think you should trade them. Again, obviously trading or options trading isn't for everyone. There is increased risk with it, but if you learn how to manage your risk and learn options trading, especially on these large cap stocks, it really pays off. And that brings me into another point. Options trade or penny stocks, for example. I know a lot of people trade penny stocks too when they get started out. They want those fast, rapid movements. What happens with playing those penny stocks, a lot of times those will be pump and dump schemes where you can lose masses of your wealth instantly or within minutes, or you can have it get halted, or it's not very liquid. So you go to buy in and there's not many people buying those shares. You can be stuck in that position. So that is really why I trade large cap options. So if you look at my trades, what I do is say Netflix, Boeing, Apple, Amazon, all those large cap stocks. When you trade options, there's always going to be someone on the other side buying it. Obviously, if you play like 30 or 40 out of the money or in the money, you aren't going to see the volume. But if you're playing anywhere near the money within 10 to 15 strikes, as soon as you send in that order, you will have a purchaser on the other end. So again, guys, if you have any questions, please feel free to reach out to me. And as always, if you could like and subscribe to this video, it'd be greatly appreciated. If this video sparked your interest in options trading, we do have a course, Alerts and Mentoring, available at simplifiedinvesting.site. It is currently 20% off, and we'd really love to teach you guys options trading and show you how simple they are, as well as how you are able to grow your account with us by playing our alerts and learning how to find these setups on your own. As always, I hope you guys have an amazing day and an amazing weekend, and we look forward to Monday. Have a good one.